Okay. So, hi everyone. Good morning, Saturday morning, and we are back again with a very interesting topic, momentum investing, which most of you must be looking forward to. And we have had a couple of Twitter spaces with Viraj Khatavkar, and today we are having a session with presentation. As most of you were asking, that it is always good to have some visible output basis which you can understand more. So, a little background of Viraj. He's a software engineer by profession, and his entry to the markets is more of a accidental entry. He was fascinated by the bull market in 2017. Like all the investors, he had made a lot of mistakes and learned from them. During these times, he had done different strategies, and finally he found out his niche, momentum investing, and he runs a very popular screener, momoscreener.in, wherein you can scan for momentum. And with that, I hand it over to Viraj to kickstart, and he can surely add to his introduction just in case anything is missed on my part. Welcome, Viraj. Viraj, you are on mute.
Sorry about that. Yeah, thank you, Prince, for this wonderful introduction. And first of all, I just wanted to say, like, how glad I am to be here. And again, like, thank you for allowing me to, giving this chance to actually present this in front of your audience and for your YouTube channel. To be honest, I just wanted to say, like, Prince has this really wonderful YouTube channel and a Twitter account. The channel has like really, really good videos around investing, not just momentum, but everything. He has interviewed a lot of prominent hosts and guests where they provide a lot of insights. I personally have found a lot of information and treasure from all those videos. So I would just say, like, please go and visit that channel once. I'm I'm pretty sure that you would like whatever you get from it. So again, once again, thanks, Prince, for this. And I think we'll just dive right into this. Before going into the presentation, I just wanted to say a couple of things. What I'm gonna do during this presentation is I want to go through the whole presentation from start to end. I'm not gonna be taking any questions in the middle of the presentation. What we'll do is, if you have any questions, you can store them for yourself right now. You can write them down, or you can, put them in the chat right now. The meeting has a group chat. You can put them in there. Prince will be monitoring the chat. And once I'm done with the presentation, he can pick up those questions and can, discuss those questions. Because there might be some questions which I might answer later in the presentation as well, which you might have in middle as well. So what I would do is I would like to go through this whole presentation first, and then we'll go to Q&A. It will take around 40-45 minutes at the most to go through this presentation, and then we will see if you have some time for Q&A as well. So yeah, today we are going to take a look at momentum investing, more like just a good tagline here, an eloquent way to grow your money. So lately, momentum investing has become much more popular in India. Most of the people have a little bit of idea today, like what momentum investing is, like Bhav Bhagwan Che, or buy what is going up, something like that, some form of that aspect. Everyone knows about it. Like if something is going up, just buy that and then sell whatever is going down. Because of a lot of small cases and numerical mutual funds that have been, launched by NSE and on based on NSE indices, etc. Momentum investing has become a lot more popular than it was, in 2018, 19, or even 2020, etc. So yeah, I think we understand what momentum investing is, basic at the very basics of it, but we are going to dive a little bit more deeper into it. So let's just get started right away. So first, in first 5 minutes, I just want to see what momentum investing is, how to build a strategy, etc. But basics of momentum investing. So what is momentum in terms of investing? Basically, in a very crude way, it is buy high, sell higher, right? So what does this mean? Like in a typical scenario, we are very price conscious investor, right? So in a traditional value investing sense, what we do is we buy low and sell high. So whenever some stocks is out of favor due to maybe regulatory issues, due to some bad decision by temporary bad decision by management or something else, which is more of a discretionary way to identify. Like the company is still quality, but due to something bad that might have happened, which might have a temporary effect, the stock price might have gone down a lot, and it provides a very good value opportunity for us to buy it. So that's one way to buy stocks. Another option to buy low, sell high is where there is a market-wide turmoil, like what happened in 2020, 2018, 2008, 2011, etc. So that is one aspect of buying low and selling higher. That's what traditionally we know value investing it is, and it basically sits in our mindset, right? In our daily lives also, we try to buy low and sell higher. Maybe it residential, maybe it is like even smaller things, like if something is on a discount, we tend towards buying it rather than something which is not on discount. So traditionally, we understand value investing because it is buy low, sell high, which is our general life's philosophy. While momentum is buy high and sell higher, which is not our regular life philosophy. So it is a little bit difficult to understand that. Uh, so it is very difficult to not just understand, but also put real substantial amount of money behind a momentum strategy, because we are already buying high, which we correlate it to as buying expensive. Although just because we are buying high doesn't mean it is buying expensive. It is just that the stock is making new highs or is very close to its all-time high, etc. So it is really very confusing for us because we are not accustomed to that philosophy in our daily lives. So that's what momentum is, but it's difficult to behaviorally understand it from our side, because we are not accustomed to it in our daily life behavior. uh, so what does it actually mean a little bit more? So why do we buy high and sell higher? Like, we understand this because we are buying low, there is some protection for us. Like, even like the stock has already fallen a lot due to its own challenges or maybe a market wide turmoil. So it makes sense. Okay, we are buying cheap, so we have a lot of room for growth and we can sell higher. But why does momentum, like buying higher, are we not proning ourselves to less protection around the stock's price? I mean, this is where the momentum philosophy comes in. It assumes that the reason because we buy high and sell higher is because naturally, if a stock is going up, we can assume that it will keep on going up until it doesn't keep going down, right? So this is like natural physics. If something is in a motion, it will keep on going in that motion until an external object comes and stops that motion. The same philosophy we try to adapt into a momentum strategy. Like, if something is keeping on going up, it will probably keep on going up unless something else out of its normal trajectory comes and stops its upward trajectory, right? So that's what the basic philosophy behind momentum investing is. There is no anchoring bias, right? In typical all other types of investing, so to say value investing or a quality investing, there is always an anchoring bias, right? Because this company is an MNC, because this company has this core brands which people know, or because this company is cheap but has a lot more assets. Like, there is always an anchoring bias. What is anchoring bias? Anchoring bias is our bias creeps in where we assign a value to something because of XYZ reasons, right? So that's what anchoring bias is in very, very layman terms. So there is no anchoring bias in momentum. We are just following whatever the screen throws in, like whatever is going up, irrespective of what the news is behind it. We don't know why it is going up, but just because it is going up, we will buy it, right? That's what momentum is all about. While value investing, quality investing, all of them has anchoring bias. Like, it has a brand, it is a MNC, it is like, for example, Maggie is a very well-known brand, and it's difficult to take Nestle away from Maggie. So that's our anchoring bias. I'm not saying, again, just understand, I'm not saying that value or quality investing is bad. They are very fine forms of investing. If you feel comfortable with them, you should probably do that. I'm not at all saying that value and quality investing are bad in any sense. I'm just saying, like, what traits are necessary for being a good momentum investor versus what traits are necessary for being a value slash quality investor. Don't assume that value and quality is bad in any sense of the way. So yeah, there is no anchoring bias in momentum, while there is anchoring bias in quality and value. It may be good, bad, we don't know the answer. I personally am not able to get rid of my anchoring bias so easily. So I basically never try to go towards value and quality investing. I typically stick to momentum investing because of no anchoring bias. Okay. Yeah. So this is what momentum is all about. Now let's try to understand why does it work. Now we are just trying to find probability of why does momentum work and not understand. We don't know, like nobody actually knows why does momentum work. It is an anomaly. Even Eugene Fama, who has said that markets are efficient, see that momentum is an anomaly, right? So same way, we don't know why momentum works. There are some reasons which we can assume. People around the world have written papers over it, like why it might work, why it probably works. We just don't know why it works for sure because it is an anomaly, right? So one aspect that everyone thinks contributes to the alpha of momentum investing is insider information. So what is insider information? So basically, promoters know their business, right? And there are many first related parties who know about the business, like okay, what all orders are coming, how much growth the business is seeing in current quarter, next quarter, over the year. So basically, insiders typically know what the business is going to look like over the next couple of years. They are not always correct, but mostly they have an idea, like the investors out of those company who are actually running the company, the investors who are outside of that don't really know how the company's business might work. However, they may, how much ever they read annual reports or how much ever research they do, it is really difficult for us to know those things. But insiders know that, right? So they know it and they will probably buy stocks if they know that the company is going to do well over the course of next year or two. So we don't know that. Insider information, we have no idea, but they know it. So they will buy the stock and that's what contributes to stock keeping going up basically. Another thing is slow dissemination of information, basically. So, for example, typically analysts, typical stock analyst or retail like us follow a lot of stocks, right? And we know like some information about the stock. But what we know is what grabs our attention. If some stock goes up, like 20% up, 25% up in an upper circuit, or 50, 100% up in a month itself, that's what grabs our attention as an analyst or a retail. And our coverage is biased towards those kind of stocks. Also towards the stocks which go down like 20% down in a month, 50% down in a month. So analysts and retail typically try to cover these extreme stocks a lot more. They spend a lot of energy into covering the stocks which have extremes. They either go extremely up or they go extremely down. But a stock which is slowly disseminating information, like it is a linear graph like this, like this, very slowly going up. It has no real very large up moves. Like it doesn't have really large up moves in the past year, nor does it have large down moves as well in the past year. It is just slowly, very linearly, very slowly going up. This doesn't excite analysts or retail because there is nothing to do. The business is just doing well. There is no extreme price information, no extreme orders, just doing good, well, month over month, year on year. So this low dissemination of information in price is basically neglected by the analysts and retail. And because this dissemination is neglected, it shows in price, but most of the analysts or retail don't cover it and don't find it very useful as such. So that's what also is something assumed which contributes to momentum's performance. Like this slow dissemination of information in price is captured by a technical momentum system, but usually neglected by our discretionary behavior. So that might also contribute to the alpha. Next is underreaction versus overreaction phenomena. So for example, if some company launches AI tomorrow and say Google gives it an order of $5 billion. So what happens here is everyone starts, oh, this is a good thing for that company. It's going to get a $5 billion order, so its market cap will grow, its profit will grow, etc., etc., etc. And that is called as an overreaction phenomena, right? So the stock will zoom up. It will go through this overreaction phase where everyone is on that stock, covering that stock, etc., etc. While most of the momentum stocks are typically an underreaction phenomena, they come in during an underreaction phenomena. So for example, stocks might be going up because the stocks have, small orders coming together. There is no big order, there is small order. The P&L is going up a little bit, etc., etc. So what happens there is there is an underreaction because the company is not getting really big orders, etc. So it is an underreaction phenomena to this slow dissemination of information in price, basically. So again, these are not the factors which everyone knows it works. These are some things which experts have identified might be contributing to momentum's alpha. Now, this is something that is not my original work. I have found this from, a variety of papers and articles that I have read over the internet from practitioners who do a lot of research around momentum. Uh, so if you want to read things like this, there is a site called as alphaarchitect.com. It is a site, US based website, mostly run by Wes Gray and Jack Vogel. Uh, they provide a lot of information on different factors like momentum, low volatility, value, etc. But a lot of information of momentum. So I would say there is no one article where you will find all this information, but I would say if you go through a lot of articles around that website, you will find similar viewpoints basically. Also, another thing that I have not mentioned here, which also contributes to momentum's alpha, is it also goes through huge drawdowns. Momentum, first of all, I just want to say this: momentum is not a holy grail system. Momentum goes through humongous drawdowns, almost equal to or greater than index, right? So it gives higher returns, but it also goes through huge drawdowns as well. So we have to be cognizant of the fact that momentum is not a holy grail system. You cannot have the cake and eat it too in a momentum philosophy. You will get humongous returns if you stick to the system, but you will also go through huge drawdowns. It is really, really difficult to avoid those huge drawdowns without letting go of the returns. If you optimize your momentum system for letting go of, like, reducing the drawdowns, there is a very high chance that you will also reduce the returns by a very large factor. So, so that's why momentum is not an easy system to follow. Okay, so this was just an introduction to what a momentum strategy consists of, how does it, why it might work, uh, why, like, what are the typical reasons that people assume that it might work. So all those things are basically mentioned here. Next, we'll try to understand how to build a basic momentum strategy. Okay. Again, this is something that I will use my website to showcase, because it is much, not because I want to advertise it, but because it is much more easier to show and explain than just just explaining it through a presentation, etc. So what we'll do is we'll just quickly go to my website. Yeah, so what we'll do is we'll just open a very simple screen, and we'll understand how to build a basic momentum strategy, right? So the first thing that you need to understand, we are not going to go through all these filters. We are going to go through important filters here, and later you can come and visit this website to understand what all filters are available. So basically, the first thing that you need to finalize on yourself is to identify the universe of stocks that you want to play your momentum in, right? So when you want to buy momentum stocks, it can be across universes. It can be an all NSE listed stocks. So this is basically all the stocks that are listed on the NSE main board, basically. Or if you want to only run the momentum on top 500 stocks, then you can select the Nifty 500 as your universe, or maybe top 200 stocks, then you can select Nifty 200 as your universe. It depends on what universe you are comfortable playing with, right? Typically, what I would assume is uh, it's better to be in a larger or a broader universe like Nifty 500, Nifty 750, or all NSE listed stocks. I would typically avoid going to a universe which is around, like you say, Nifty 200 or Nifty 5, Nifty 250 or something like that. I would personally typically avoid running momentum systems on those universe of stocks. The reason is there are better alternatives there in terms of mutual funds, as well as there is not much alpha which will remain there, because those are broad large cap, mid cap, large cap stocks and large mid cap stocks. So they are most of the analysts are covering them. There is high liquidity in them, so most of the mutual funds buy them. So there is no really alpha, not major alpha pending there over the long term, after the tax that you pay through STCG, LTCG versus mutual funds, etc. So I personally would typically avoid choosing a Nifty 200 or Nifty 250 momentum. But if you want to experiment, sure, or if you want to try, you can go ahead. But I would personally not do it. I would only do a DIY where you are actually doing a momentum system by yourself only on a universe of 500 stocks or more, basically. Next, you need to be able to rank your stocks, right? Now, there are a variety of ways to rank your stocks. One very simple way is absolute return 1 year, right? So, what is absolute return 1 year? It basically means absolute return 1 year basically means that what is the return of the stock over the past 10, 12 months, right? So that's what absolute return 1 year means. Uh, so absolute return 1 year is whatever stock has given the highest return in the last 1 year will be ranked as first, and whatever stock has given the lowest return will be ranked last. So whatever stocks has the highest return will be ranked first, whatever stocks has the second highest return will be ranked 2, and so on. We will rank all the stocks from ascending order of their ranks. So the highest return stock comes as 1. Other option is sharp return 1 year. What is sharp return? In sharp return, what we do is we divide the absolute return by its 1 year volatility. Now, what is the reason for dividing by volatility? So, because we divide 1 year return by volatility, we are basically penalizing stocks which have high volatility, right? So if a stock goes up 100%, if stock A goes up 100% 1 year and stock B also goes up 100% 1 year, but say stock A does it at 25% volatility, but stock B does at 50% volatility, then stock A will be ranked 1 because 100% return divide by 25% volatility is equal to 4, while 100% return divided by 50% volatility is equal to 2. So 4 is higher than 2, right, in terms of sharp return. That's why 4 will be ranked 1, while 2 will be ranked later. That's why in sharp return, what we do is we penalize volatility of stocks. If a stock is going up a lot, but it is doing so at a very high volatility, we basically penalize the stock. That's what sharp return 1 year is about. And then median daily volume, right? So median daily volume is something that you need to figure out. Before going to median daily volume, you have to also, like, there are a lot of other filters that you can rank. So sharp return 1 year, if you want to rank on sharp return 6 months, 3 months, or you want to take an average sharp of 12.63, 12.96, 3 months, etc., etc. So there are a variety of ways to, rank these stocks basically. Next, we need to also make sure that the stocks are liquid. We don't want to just buy stocks with low liquidity. So what is the median daily volume of the stocks over the past 1 year? I typically keep it as 1 crore because that's what makes sense to me. It's up to you what you want to keep, but typically anything about 25 to 50 lakh is must. 1 crore is good enough. You can go ahead with 1 crore median daily volume until you reach, say, 30, 35 CRs worth of, your portfolio value. It is fine. Next, away from 1 year high. So I typically keep it at 25%, but you can keep like whatever you feel comfortable with. So for example, away from 1 year high is basically, what does it mean is how much is the stock within 25% of its 1 year high or not? That's pretty much it. You can also you can also figure out if you want to have an away from all-time high filter rather than a 1 year high filter, etc. So it's up to you. Both of them work quite nicely. I prefer away from all-time high rather than away from 1 year high, but it's up to you. Mostly the performance is same across both the filters. Then if you want the stock to be about 200-day moving average or 100-day moving average, uh, minimum 1 year return is annual returns greater than annual volatility. How much of the days in the past year are positive, like percentage of days which are positive in past year, 6 months or 3 months. Uh, like we also want to exclude stock if they are currently in a lot of circuits, right, etc. So there are a lot of filters here. We are not going to go through all those filters because it will just take a lot of time. But these are typical filters that you can use to form your system. And once you rank those stocks, you can get a list of stocks that you can invest in. Now, typically, uh, what I would say is if your universe is Nifty 500 or say Nifty 750 or all NSE listed stocks, I would typically say like 25 to 30 stocks is something which is good enough. 25 to 30, even for a all listed NSE cap universe, maybe 500, maybe 50 stocks are also good enough. So it's up to you between 25 to 30, 40, 50 stocks. is a good enough number of stocks for a momentum portfolio, basically. And then how to run a momentum strategy, right? So if you're starting today, what you will do is you will basically buy this top 25, 30, 40, 50 stocks. And then on the day of rebalance. So what is rebalance, right? So rebalancing is something when you evaluate your system again, okay, which stocks have stopped performing and I need to exit them, which stocks have stopped sorry, which stocks have come higher in the ranks, I need to buy them, and the stocks which have gone lower in the ranks, I need to sell them. Okay, so this is what we will do on January 1. Let's say I buy these 25 stocks. Let's say let's do one thing. We'll go to my own momentum screen. Okay, here. So this is my momentum. These are the exact rules that I follow for my personal momentum system. We'll come to that in a sec. But let's suppose I start my momentum system on say 1 August 2024. So we'll take the stocks as of 31 July 2024 according to the rules that I have for my own momentum system. So these are the stocks that were valid on 31st July 2024 according to my rules, right? So what I will do is I will buy the top, say top 30 stocks from, I will start buying from top first stock. Suppose I have 30 lakhs rupees. So I will equally divide the money into all 30 stocks. I will invest 1 lakh in Cochin Shipyard, 1 lakh in Trend, 1 lakh in SBGLP, etc. I will start from the rank one and I will invest 30 lakhs equally in all the 30 stocks. Okay. Now suppose on 1 August, sorry, this was on, according to the ranking on 31st July, I buy all the top 30 stocks on 1st of August. Now on 31st of August, I again see, okay, it's been 1 month. So this is called as monthly rebalancing. From 31st July to 31st August, we don't do anything. We just let the system stay there. We don't exit any stock. We don't buy any stock, new stock. But on 31st August, we again check, okay, it's been 1 month since I bought the stocks for the first day. Now, what is it? Now I will reevaluate my system on 31st of August. Okay, I will see what all stocks that I bought on 31st July are ranking now on 31st August. So what we'll do is we'll open this screen again here and we'll keep both of them side by side. So let's go to 31st July back again. Okay, so 31st July, we bought this stock. Like Cochin Shipyard was ranked 1. Now, if I come here and I search for Cochin Shipyard, where is it? So Cochin Shipyard is not even coming into my list. Why? We don't know. It may be because of circuit. It may be because of not being in, within the high or some other reason. But for some reason, Cochin Shipyard is not in my system, not in my rankings on 31st of August 2024, which I bought on 31st of July 2024. So I will exit Cochin Shipyard on 31st August 2024. What is the next stock that we had? Trent. So let's see Trent. Trent is still ranked 1, right? So we will not exit Trent. Trent will still remain in the system. Next was SBGLP. Is SBGLP still in the top ranks? Let's search for it. So SBGLP. So SBGLP is on 18th rank, right? So should we keep it or not keep it? Before SBGLP was in 3rd rank. On 31st July, SBGLP was a 3rd rank, while on 31st August, SBGLP is at 18th rank, right? So this way the ranks change for all the stocks every month. Now what we should do is there should be a concept of worst rank held. So what is worst rank held? When should it defines when should we exit a stock? Now what happens is we bought these stocks, top 30 stocks on 31st July 2024. Now on 31st August, if any of the stock is beyond 60th rank, we will exit it. If it is not beyond 60th rank, we will keep it. This is the rule that we will follow. So to reiterate myself, whatever 30 stocks we are buying, if any of the stock goes beyond 60th rank on 31st of August, we will exit it. If it is not going beyond 31st of August, if it is not going beyond 60th rank, we will keep it. Okay. This way, we will have some exits. And whenever we exit those stocks, we will have some more entries from here, which are not there in our portfolio. This is how a basic rebalancing of a momentum portfolio seem like, right? Now, this is my momentum screen. So we'll go quickly through it, what my rules are. So basically the index is all NSE listed stocks. I prefer my index to be all NSE listed stocks. I rank them by average sharp of 12, 6, and 3 months, highest to lowest. My median daily volume filter is 1 CR. I don't apply filters for away from 1 year high or away from 5 year high. I have a within 25% of away from all-time high filter. The stock should be about 200-day moving average, and its minimum 1 year return should be 6.5%. I don't apply any other filters, except I don't buy B stocks. I only keep stocks which are in the EQ series of the NSE. NSE has two series, EQ and BE. BE series is for those stocks which are in long-term ASM stage 4, which are only trade to trade stocks. So the liquidity is quite less in B stocks. That's why I avoid stocks which are in BE series, right? So I avoid any stocks which are in the BE series. I also ignore the top beta stocks because basically what I've observed is top beta stocks typically underperform over long term in low beta stocks. So I typically ignore any stocks that is in top beta, like the top percentile of the beta of that universe. And there is no other filter. I keep a market cap filter of minimum of 850 crores. So basically, any stocks which is below 850 crores in market cap, I do not buy it. So for me, the minimum value for market cap is 850 crores. So why 850? Typically, what I'm trying to do here is I'm trying to mark it up to $100 million in value. So $100 million in US dollar terms is 850 crores in rupee terms, right? So that's why $1 billion is 8,500 crores, approximately with the conversion of USD INR. While in so for me the breakup, like the break of market cap is $100 million, and that $100 million when converted into rupees is 850 crores. That's why I keep this 850 crores as market cap filter, and I don't buy any stock which is below 850 crores. These are the stocks that I do. So for me, the total number of stocks that I keep are 50. My worst rank held is 100. So to reiterate again, these are my rules. I buy top 50 stocks and my worst rank held is 100. Basically, any stock that goes beyond the 100th rank, I will exit it. That's pretty much it. So these are my rules. These are the filters that we have available for a momentum screen, not just in terms of what is available in the screener, but in general, what you can typically apply. Typically, I would say a combination of these filters is fine. uh, the more filters you apply, there is a very high probability that your returns will reduce, but your drawdowns will reduce as well, but your returns will also reduce. The lesser filters you apply, uh, I would say your returns will increase and your drawdowns will increase as well correspondingly. Typically, I would say sort by, I would say avoid by absolute return. I will typically try to keep it around sharp return. Any combination of sharp return is fine. Sharp return penalizes for volatility, and in general, in my backtest, what I observed is a momentum system ranked from sharp returns typically outperforms than a momentum system ranked by absolute returns. So I would say sharp return is something that you should rank by. Any kind of like sharp return, 1 year sharp return, 6 months, 3 months, or an average of them. Either way, it is fine, not an issue as such. Median daily volume, as I said, keep at least 50 lakhs. 1 crore is preferable. I would say away from 1 year high or away from all-time high, either of them is fine. If you keep away from 1 year high and not away from all-time high, then you will get more of stocks like Suzlon, etc., which may not have performed, which may be very much away from all-time high, but have recently started performing and within its 25% of 1 year high. So it depends on what kind of mindset you want to have for the systems. Rest all things you can use your gut feeling or back testing to find like whether it works or not for you, etc. Okay, so yeah, coming back, this is what was a very, because it's very difficult to like I can do a whole 1 hour or a 2 hour session on how to build a momentum strategy. So it's difficult to combine in 5-10 minutes. So I try to give you the basics of it. What are the filters that you should typically use? What are the pitfalls, and how you should rebalance, etc. But obviously, you can always ask me questions. You can email me, or we can talk about it later as well. Now, I explained my strategy. Now, I just wanted to walk you through the backtest of my own strategy. Again, these are my current set of rules. In future, I may change my rules. there is a very high possibility that the rules might be changed for my system if I find something good. So don't take this. This is not set in stone. The rules that I've defined for my personal momentum strategy are not set in stone. The backtest is for the current set of rules that I do. One more set of rules that I wanted to identify. I don't invest in any stock which has greater than 20 circuits in the past year, basically. Now, yeah, coming back. So we'll go through the backtest of my strategy quickly. Uh, the reason is not the reason we're going to the backtest is not because we want to see the returns of my strategy, but because we want to understand the characteristics of backtest. We want to understand what all things we need to see in a backtest before identifying a good strategy, momentum strategy to invest in. So please don't just look at the returns, but returns and drawdown, but also look at the characteristics that I'm looking at for a momentum system, which will help you to define your own system, which you can stick to over a long term. Now, this is what the backtest was. So I initially started with 50 lakhs. The backtest, yeah. Before I go into the returns, let me explain you the parameters of this backtest. It is exactly similar to what I have written in the rules of my filter. The backtest is executed from 1st January 2007 to 31st March 2024. Okay, 1st January 2007 to 31st March 2024 is the period of the backtest. Now, as you can see, I started the initial capital that I started it was with 50 lakhs, and the ending capital has been 26 crores. The annual return here is what the CAGR is, 25.90%. So this is what our capital would have grown from 50 lakhs to 26 crores from 1st January 2007 to 31st March 2023. And the annual returns, the CAGR returns would have been 25.90%. Next, winners. So this is what before going to drawdown and everything, I just wanted to tell you how a momentum system winners and losers look like, right? So if you see, out of the total stocks we bought or out of the total trades that we took, only 46% of them were winning trades. So less than 50% of our trades were winning trades, right? So 46% of the trades were winners, while 54% of the trades were losers. So all the trades that we took, higher number of trades were losers, while lesser number of trades were winners. But if you observe something, the average profit here is 48.90%, while the average loss is only 11.36%. Okay, so what this means is, even though our winners are lesser in percentage terms, the average profit of winners is much higher than the average losing percentage on losers. Why? Because momentum system quickly discards anything that is going down. If a stock is going below its ranks, we exit it, right? So this means we don't have a stop loss in place on a price basis, but we have a stop loss on the basis of ranks. So a momentum system will quickly discard a stock which will go away from its ranks, right? Yeah, so that's what. And this is what the characteristics are going to be in a typical momentum system. Like the average profit, the number of winners are going to be always lesser than the number of winners, but the average profit of winners is going to be much higher than the average loser on a losing position. So here, as you can see, the average profit is 4 times higher than the average losing position. So this is what contributes the overall alpha of the system, basically. Next, this is the year-wise returns, basically. Again, this is something that I've just put in to understand the nature of the system. So as you can see, 2007 was a good year. 2008, we went through 38% drawdown. So the index went through something like a 50% drawdown, if I remember correctly. We went through a 38% drawdown. And these are the year-wise return, like 2009, 10, 11. Again, we went through a 14% drawdown. In 18 also, we went through a drawdown. 22, which was a Russia war and the whole tech crisis, we went through a little bit of drawdown. 2023 was a really good year, etc. Now, I just want to tell you, like, these are back-tested returns, right? So expect expect a higher drawdown than what you see in backtest. In backtest, everything is pristine, right? We can entry and exit at whatever values we want, etc. While in a real system that we might run, we might not get fills on our exits, we might not get fills on our entries, or we might get, bad fills on our entries. So those things we have to consider on a real system. So expect a little bit of a lower returns on a actual traded system, and a little bit of a higher drawdown on an actual system. So the drawdown chart I have not mentioned here, but the drawdown here was basically around 42% for this whole system, basically, right? So yeah, this was the backtest of my strategy. Now there are a few things that you need to understand here before we go ahead, right? This is just one path of backtest, right? This backtest was performed for a singular period, that if we start on 1 January 2007, and 1 January 2007 we start and we end it on 31st March 2024. That was the only period this backtest goes to, right? We cannot really go back into past and put all our money on 1st January 2007 and exit on 31st March 2024. That's just not possible, right? So this backtest only gives us one pathway. So we should not just trust one pathway of the backtest. We want to make sure that this will essentially perform nicely, even if, even if we start at certain amount of time. Nobody puts 50 lakhs at one point of time in a system and then runs it for 25 years or something like that. Not 25 years, something like 15, 18 years. You probably put in more money over the time. You do an SIP into a system. If you go in, like if you get a bonus from your job, you put in more money. If you sell something, you put in more money. You sometimes take out some money from the system because you have some needs out of it, etc. So you should never trust a back test on just one path that it has gone through. A back test needs to be needs to be looked at in a case of rolling return, not just one pathway. So what we'll do is we'll analyze the rolling returns of this system. So what I will do is I will just zoom this a little bit. So these are the rolling returns of my system, 3-year, 5-year, and 7-year rolling returns. So this is what is very important for us. So this chart explains how your returns would have been if you started at a certain point in time. So the first data point here is sometime is January 2010, and the last data point is 31st March 2024. So why for 1st January 2010? It's for a 3-year return, right? So if you started your system on 1st January 2007, the first 3-year return or CAGR you will get was on 1st January 2010. That's why the data point here starts on 1st January 2010. So what is this graph? Let me explain it quickly a little bit. So what this graph does is it takes all the data points in the systems. For example, if you started your system on 1st January 2007, how your 3-year rolling returns would have looked like. If you started your system on 2nd January 2007, how your returns would have looked like. If you started your system on 3rd January 2007, how your system returns would look like. So this rolling return chart, take this data point for all the dates that are available between 1st January 2007 to 1st January 2021, 31st March 2021 for the 3-year rolling returns. Then 5-year rolling return, same way. The data point starts in 2012 because from 1st January 2007, the first 5 return will be available in 2010, 12, and for a 7-year rolling return, the first return will be available in 2014, right? So these are the 3 charts that you see. So as you see, if you started in 2007, after 3 years as well, your return would have been positive quite nicely, CAGR. So this is all CAGR, not average or absolute return. This is CAGR chart basically. So the 3-year CAGR, this is blue line represents the 3-year CAGR over different time periods depending on when you would have started your system. So if you had started on the worst possible time, like the top of the 2008 bull market or the top of the bear market, then even after 3 years, your CAGR would have been slightly lesser than 0. So bear this in mind. Luck also plays a lot of part in when you are starting your momentum system. If you started at the worst possible time, your 3-year CAGR would have been 0. The 5-year CAGR has always been positive there was not a single period in 5-year CAGR where it was negative. And the orange or yellow line, whatever you're seeing it, is the 10-year, 7-year rolling CAGR. That has also been always been positive and almost always about 10% as well. So if you see one more observation, the 3-year rolling return line is very haphazard. It goes up, then it goes quite down, then it again goes up, etc. Right? While the red line is quite flat. It is not like it does go up and go down as any system will do in return terms, but the variability of the red line is quite lesser than the blue line, and the variability of orange line is much lesser than the red line as well. So what this means is the more longer you stick to this system, and this analysis is of my personal systems backtest, but this will be there for any momentum system. Just take this chart as analogous to any momentum system. So the more you stick to a momentum system over long term, there is a very high probability that your returns are mostly going to be positive and in a similar range. So to keep out, or take out the whole probability of losing money over a very long term, it's necessary that you stick to the system over very long term. And quickly seeing a couple of more things here. So this is something else. So this has been the average 3-year rolling CAGR, median CAGR, lowest, highest. So the lowest, like if you started on the worst possible time, the lowest 3-year CAGR you would have gotten is minus 2.23%. While if you had started at the best possible time, the highest 3-year CAGR you would have got is 61%. And similar, this analysis is for lowest, highest for 5-year, 7-year, and 10-year rolling CAGR, etc. And this is like how many of the percentage of times you would have gotten at least 5% returns versus 10% returns versus 15% returns, etc. So over a 10-year rolling period, all of the time you had gotten at least a 10% CAGR. So if you stuck to a momentum system for 10 years and 7 years as well, 100% of the times you had got at least a 10% CAGR. 93% of the times you had at least got 10% CAGR over 5-year rolling, over all the 5-year rolling periods as well. So as your time horizon increases, the probability of your CAGR being positive and above inflation also increases. Again, one more thing that I want to point out this graph is uh, the history of Indian markets is very low. US has history from 1920s, etc. So more than 100 years of history. So they can practice their system over 100 years through a variety of economic cycles, inflationary cycles, recessionary cycles, etc. Our history of stock markets is less than 15, 18 years at the most, right? And I'm saying good history. Like our stock markets were there from 1990s, but there is no good data of stock available anywhere. The stock data available, proper stock data is available only from 2004, 2005, right? So the history for our stock market is very less, around 15 to 18 years. So it is very, and most of this 18, 15, 18 period year has been a bull period. Majority of that period has been a bull period. We did like most of the crashes have been, flash crash, like it goes down steeply and then it recovers fast. Like from 1994 to 2004, there was a very prolonged 10-year bull market in Nifty, but we don't have stock price data to test whether how momentum system would have performed during those period. So all the back tests that you see, take them with a grain of salt, because our stock market history has been very minuscule. So I'm not sure how this will perform in prolonged inflationary or recessionary periods. So we have to take all of this with a grain of salt as well. As we become more mature, hopefully over the course of 15, 20 years, we get a more robust history for our stock markets, and we can do much better, backtest as well. Yeah. So going ahead, we have seen the rolling returns as well, and rolling returns is very essential to analyze in a backtest of a momentum system. Next, we are almost coming towards the end. So many a times I get question like DIY versus mutual fund, right? So DIY is do it yourself. What it means is, screening stocks by ourselves, and then, doing the whole transactions of buying and selling, etc. versus investing in a mutual fund. NSE has recently launched a lot of momentum indices, right? So if I open this niftyindices.com website and I go to strategy indices, there are a lot of momentum indices here, as you can see. So Nifty multi-cap momentum, Nifty mid small cap momentum, then Nifty 200 momentum is, yeah, Nifty 200 momentum, the new index, Nifty 500 momentum 50. So lot of momentum indices has been launched by NSE, and a lot of mutual funds are launching based on these passive indices, rules-based indices as well. So does it make sense to do a DIY versus investing in a mutual fund, right? So this is a question that I get a lot and something that I want to answer. So there are two things here to see. First is plain calculation, and the next is how to look in terms of mutual funds versus DIY. So first, let's just take a look at this calculation. Sorry. So this is a calculation that I quickly done. So let me explain what this calculation is. So this calculation is on the NAV of Nifty 200 Momentum 30 Index. So there is this NSE index, momentum index launched by NSE, quite for the first of the momentum indices launched by NSE. It is on the 200 stock universe. So top Nifty 200 is the stock universe, and it takes the top 30 stocks as as its top 30 stocks in ranking, and worst rank held as 60, if I remember correctly. So the NAV taken for this calculation is for that Nifty 200 Momentum 30 Index. These are the returns that we see from 2005 to 2023. These are the annual returns of that. And what I've done is I've calculated the MF NAV. So if you had put some money at the start of 2005 in MF, and exited at the end of 2023, the only tax that you would have to pay would be the LTCG tax, right? The 12 and the new tax structure that launched in the recent budget. So 12.5% of LTCG is what you would have had to pay on the overall gains that you have gotten after these many years. Then I considered a DIY system, and in a DIY system, what I've considered is I've considered the similar NAV. Like suppose if I gotten exactly the same returns, no difference, okay? Exactly the same returns as I had gotten on the Nifty 200 Momentum 30 Index. The only thing that I did was I did it through a DIY way, where I bought the stocks manually in a brokerage account. I exited them depending on its worst rank held, every year, and then bought, sorry, every month, and then, sorry, every 6 months, and then bought them again, etc. So if I had done that, what my NAV would have been. So the reason to do this is this will give us the break even, right, between DIY and mutual fund. This is not to analyze whether a DIY system with the similar returns will beat MF. Obviously, it won't, because we are paying taxes every year, right? So let me first explain the taxes. If you invest in a mutual fund, you only pay a 12.5% LTCG tax at the end of 2023 when you redeem your whole amount. In a DIY system, you pay STCG almost every year on the profitable exits that you do. Okay. So this would have been the CAGR. If I have gotten exactly the same returns on a do-it-yourself system, my CAGR would have been 17.17% post-tax after assuming 20% STCG on this momentum system. While if I had invested in mutual fund, my post-tax, which is after LTCG, my post-tax CAGR would have been 19.34%. So the difference is of 2.17%. So this becomes our break even. So how do you decide whether you should go to DIY or whether you should go for a mutual fund route? The answer is this break even. If you think your DIY system can, give you an extra alpha of more than 2.5-3% over a long period, it's okay to go through a DIY system. Otherwise, stick to MF. That's pretty much like, this is a very simple answer if you are confused here. Like if you are confident through your back test or your gut feel or whatever your active experience has been, if you're confident that your uh, DIY system can beat the momentum mutual fund by 2.5-3% in alpha CAGR over a long term after tax, after post tax. That is very important. Not just absolute returns, but after paying the STCG. If your system can break even by 2.5-3%, then it is fine to continue with your DIY system. Otherwise, continue with a mutual fund basically. This is what my answer is. But again, we have to keep these caveats in mind, where Indian stock market history is very, very short. Most of these NSE indices are launched recently and on the backtest, which have been done from 2005 or 2006, something like that. None of these backtests have been done on prolonged bear markets like the one we have seen between 1994 to 2003, 2004. From 2000 to 2003, NSE had very, very low liquidity bear market. The market was, it was not a flash crash. It was, steadily going down. Like just imagine for 3 years, market is slowly going down, not going up. It was not a flash crash like 2008 or 2020 and then a quick recovery. It was very slowly going down and down and down for 3 years. So imagine a market like that. Will your system, maybe your system will go through a 40-50% drawdown and it will come back in a bull market later. But will you be able to stick through that 40-50% drawdown in your system or not? Those are all the questions that you have to answer for yourself. Nobody is going to answer them for you. You have to answer them for yourself. Can you stick to it, basically? So these are all the questions along the alpha, as well as whether you can stick with the churning, stomach churning drawdown, gut wrenching drawdown. Then it makes sense to go through a DIY. Otherwise, it doesn't. Another thing that I wanted to say is, don't try to go through 10 different momentum systems through small cases, or subscribe to maybe one small case if you want to, if you like small case way of investing, because you pay fees for every small case and that eats up into your return. If you try 10 different momentum systems, your rebalancing will be higher across 10 different systems. Your churn will be higher, and churn, or the transaction cost. And when I say transaction cost, it's mostly the STT that you pay, the uh, the exchange transaction fees that you pay, the GST that you pay on all these fees when you churn your portfolio. That is also something which eats up into your returns. So try to stick to a monthly rebalancing than a weekly rebalancing, and try to optimize around this. Even a 1-2%, like saving 1-2% over a saving 1-2% CAGR in costs over a long term, like 15-20 years, adds a lot of overall value into our system. Like 1-2% seems lower, but not in absolute terms, but 1-2% CAGR over 15-20 years makes a humongous difference uh, in the end value of the portfolio, basically. So think about all of these things before you decide DIY versus MF, what rules to decide, the churning, monthly versus weekly rebalancing, etc., etc., etc. There are a lot of decisions to take care of about here, and please think of all these things before you decide on a momentum system. Lastly, I want to highlight two books here. If you are very new to momentum system, if you understand the basics of momentum system, like buy high, sell higher, we should buy because it goes higher, etc., and you understand the basic of the rules, I would say no need to read a book, etc. But if you are a very newbie and want to understand the basics, very basics of momentum system, these are two good books. So Quantitative Momentum by Wes Gray and Stocks on the Move by Andreas Klinau. Both of them are really, really good books. You can check them out. Wes Gray actually runs a ETF, a momentum ETF in the US market. It is called as QMOM. QMOM is the ETF that he runs. You can check out that ETF as well. It has not been performing that well after Feb 2021 high, but anyway, you can check it out. Andreas Klinau doesn't run any ETF per se, but yeah, he has quite a bit of good insights in that book as well. Again, I would say if you have a basic understanding of momentum system and understand how to identify like basics of the rules, etc., I would say no need to read these books. They don't really offer anything great in terms of that. If you have a basic understanding of momentum systems, but if you are a total newbie and don't know almost anything or very little, then I would say these books, one of these books is a good, or both of these books are good, basically. So yeah, I mean, this is pretty much it. I hope I have been valuable in explaining about momentum strategy, like what is momentum strategy, how it works, how to build a basic momentum strategy, how to perform backtest, what are characteristics to look at, and how to switch bit like how to choose between a DIY versus a mutual fund, etc. So I hope it has been valuable. And if there are any questions, I would obviously be open to taking it. Prince, over to you.
Thanks, Viraj. Really insightful and surely great in the momentum part. A lot of takeaways for our audience. So, quick questions if there are any from our audience, 5-10 minutes we can see for that. One, two questions already in place. So, Ragini is asking, you bought the initial portfolio with equal weightages. Now, when you go for rebalances, weightages of all stocks would have changed. So how do you manage the weightage of exits and new entrants? And secondly, she's asking again, you try to keep all stocks at same weightage, but when then the cost of rebalancing won't be too high.
Yeah. So I don't equal weight stock after I have bought it. So for example, let me get to that example. I have 30 lakhs. I invest in suppose top 30 stocks, right? Example, I'm taking this as an example, 1 lakh in every stock on 1st of August 2024. Obviously, on 31st August 2024, the weights of the stock would have changed depending on any. Some of them might have gone up, some of them might have gone down, etc. Right? So what I do is I do not change the weight of the stocks. What I do is basically if a stock has gone up in weight, it's fine. If a stock has gone down in weight, it's fine as well. What I do is there are two approaches to rebalance here. One is if you are not putting any extra money in the system, then what you can do is whatever money you get from exiting the stocks which have gone beyond your worst rank held. So suppose you are selling 5 stocks which have gone your worst rank held, and you might only get 4.5 lakhs. You had invested 5 lakhs on 1st August, but you only get 4.5 lakhs because you're mostly gonna be exiting stocks which have gone down, right? So you just divide that 4.5 lakhs into new stocks that are entering, and equally divide that 4.5 lakhs equally into these new stocks. That's pretty much it, nothing else. So this is one way to approach. This is what I generally explain everyone to do it. No need to add extra money, etc. If you have already committed some amount. Other thing is if you're SIPing into this momentum system, add this SIP money into these new stocks. So 4.5 lakhs plus whatever SIP money you are putting, and whatever this, suppose you're doing a 50,000 or a 1 lakh SIP, 4.5 lakhs plus 1 lakh as an SIP, 5.5 lakhs rupees divided equally into the new 5 entrants and buy them. Basically, that's pretty much it. So don't try to re-equal, like bring every stocks to equal weight in every rebalance. It is not possible for us. It requires a lot of money and goes and brings in a lot of transaction. It's not worth it. It doesn't really, improve the performance of the system in any way. So it's okay to not bring everything back to equal weight on every rebalance. Let your winners run. That's totally fine. Yeah, Prince, any other questions?
Yeah, Viraj, one more question is from Yashash. She's asking, how did you come the rebalance dates and number of stocks? Why monthly? Why 10 or 20 stocks based on back testing?
Yes. So basically, what I've seen is if your universe is 500 stocks or more, typically less than 25 stocks, less if there are less than 25 stocks, the drawdown increases quite a bit. The returns are a little bit higher, but the drawdown increases drastically. So what I've seen around 25 stocks or more, the drawdown starts reducing by quite a bit, while returns also reduce, but they don't reduce a lot. So this is how I have come to the number of stocks around backtesting. Like for a universe of stocks which is Nifty 500 or more, 25 to 30 stocks is minimum. I personally have decided 50 stocks for my own momentum system because I'm very worried about drawdown. I know that my backtest shows 40% drawdown, but in reality I can get a 50% drawdown, and it's gut wrenching. So I don't want to go through a very huge drawdown. I'm ready to let go of some part of the returns for a lower draw. The drawdown reduced from say 50 to 53% to 40% if I do like say from 30 to 50 stocks, while the returns reduce from say 27% to 25%. So I'm okay to let go of 2% of CAGR for a reduction in 10% of drawdown. Again, this is a personal opinion. This is something that you will decide for yourself because you might not have been fully allocated to momentum. My whole equity allocation is allocated to momentum. I don't do any other equity investing. My whole equity allocation is allocated to momentum only. That's why for me, drawdown is an important aspect. It might be different for you, and for you, maybe return is, better for you. And monthly,
So,
weekly, again, sorry, just one part of that question. Monthly, weekly rebalancing against monthly has lesser churn, weekly has higher churn. Weekly definitely reduces the drawdown a little bit, but the higher churn is definitely not something that I want to do. So this is what I finalized. By default, I will be on a monthly rebalancing schedule, but in very high volatile periods like say COVID or 2008 crash or something like that, I will switch to weekly rebalancing. But all other times, I will stick to monthly rebalancing. Yeah.
so two more quick questions. Puneet is asking, does your strategy beat Nifty 500 Momentum 50 Index post tax?
So I haven't checked it. Nifty 500 momentum was launched very recently. I haven't checked it. Also, this index, I just wanted to quickly say something. This index is Nifty 500 momentum 50. It also invests in small and mid caps. It is a backtested index. It's very difficult. I'm not sure how it will perform in future. I'm a little bit worried about this index. I'm not worried about the Nifty 200 momentum 30 index because it only invests in highly liquid stocks. But this index I'm a little worried about because it also invests in small caps which can have very low liquidity. And if the EM of this index goes like, about 10, 15, 20,000 crores, I just don't know how it will perform, whether it can enter and exit properly or not. So I'm a little bit worried about only backtested returns of this index. I would wait to see how it performs for at least 10 years over multiple cycles. But yeah, I have a plan to, compare my returns with the returns of that index. I haven't checked it out yet, to be honest.
Right. So last question is from HSS. He's asking, okay, if we exit a stock day after 2 years and from 1 lakh investing as equal weighted portfolio, now it is 1.5 lakh. Do we invest whole 1.5 lakh into the new entry or bring it back to 1 lakh, or what to do with the incremental zero point 0.5 lakh?
So what? Okay, so let me just quickly read it. Yeah, ideally, I would basically. So I would typically what I would see is if 1 lakh was invested, say in a 30 stock portfolio, for 1 lakh was invested in a single stock, and after 2 years it has become 1.5 lakh, it's fine to invest that in the new entrant. I don't see anything else. But if you don't want to do that and want to bring only invest the original investment amount, you can invest 1 lakh into the new entrant and divide the 50,000 that is pending equally into the rest of the stocks as much as you can. That's pretty much it. But I would personally, if in a 30 stock portfolio, if I had invested 1 lakh in a single stock, so 30 lakhs in overall portfolio, I would typically exit and enter again with the whole amount that I got after exiting.
So Ragini has another question, so we can take these two questions quickly. So all the index on your website under screens, example under sharp-based momentum are survivorship biased adjusted.
So I don't know what this means, but basically, I take the index from NSE website and I have them adjusted until like the historical data you can only see from 1st April 2024. You cannot see historical ranks before 1st April 2024. So I update indices once every month. So that's pretty much it.
Right. So Aman, last question for the day. So hi, I want to know if my investing universe, all stocks return goes negative, then what we have to do?
Yeah, nothing. I mean, if you have finalized with the system, and if the return goes below zero, it's what you have to stick with. Like there is a very high chance that it might go to zero in a year or two. Like over a 3 or a 5 year period, you can have, like, depending on when you start, there can be periods where your CAGR might be 0% or pretty much negative than 0%. Uh, or maybe you're asking if one of the stocks returns. Yeah, basically so there are two ways. If your system CAGR goes below 0%, you have to stick with it. There is nothing really you can do. That is a part and parcel of the market. And another aspect is if any of the stock in your filter goes below 0%. So basically in my filters, I have a filter that minimum return of 1 year should be equal to 6.5%, which is basically our repo rate, India government's repo rate. So I would say if a stock returns goes below 6.5%, I will basically exit it. I will not keep in my system.
Right, Viraj. So questions are keep on coming, but last question we can take. Still have 2 more minutes.
Sure.
So how can we follow you or your portfolio? Would you be giving hand holding or guidance in beginning for at least 6 months? That is one. And secondly, how do you maintain conviction during the drawdowns?
Yeah, so you can follow me on Twitter at the rate Viraj Khataukar, same as my name, VIRAJ KHATAVKAR is my Twitter. If you subscribe to this Momentum website, the premium plan, it costs 3,999 per year. You get access to the screener, obviously, but you also get access to a Slack group, a Slack group which is only accessible to the premium members of this website. So I'm pretty much active there. You can ask me questions there, etc. So you can either follow me on Twitter or on the Slack group. Plus, on my website, there is a tab, My Performance, where I update the performance of my portfolio. So you can keep a tab on that for how my portfolio is performing. I'm not a registered investment advisor, so I don't give any advice per se on which stocks to buy, which stocks to sell, or etc. So there's that. But yeah, you can follow me here. And what was the next question? Or was that it? Hey, Prince, you're there? Okay, it seems Prince has disconnected or maybe gone. I will just take one more question that I can see in the group chat. How do you maintain conviction during drawdowns? To be honest, I haven't got through a very huge drawdown. As you can see, I started venturing into momentum around 2021. Uh, so as you can see, I've, I experimented with a little bit of money. I seriously committed to momentum only in 2023. Like I put all my equity allocation to momentum strategy only at the start of 2023. So basically, I haven't gone through a huge drawdown. So I really don't have an answer to your question, like how do I maintain conviction? One way that I optimized myself is that overall my equity allocation is only 50%. Okay. So my allocation is like this: 50% to equity, 25% to gold, and 25% as cash. So all this 50% of my net worth, 50% is allocated to momentum, and whole of this 50% is in equity. So my equity is equal to momentum. So that's how I am optimizing for my behavior, like 50% allocation to equity, which is wholly invested in momentum system. That's pretty much it. So this way I can, even if I go through a 50% drawdown in the momentum system, I'm only on a 25% drawdown on an overall net worth level. So I'm going to be fine, more or less. So that's how I'm trying to manage it basically. I would say never invest more than 50-60% of your, investment in the momentum system because it does go through huge drawdowns. So yeah, I mean, I don't see any more questions in the group chat. Uh, I would say thank you for joining the session, asking the questions. I hope this it has been informative for all of you. And obviously, do follow me on Twitter if you want to follow my updates or join this website. Or you can also email me on viraj@momoindiascreener.in for any questions. I'm not very responsive on the email. I might respond to you after say a couple of days, but you'll receive a response for sure. It just might be a little bit delayed because I also have a day job, as you know. So yeah. So, but yeah, it was really wonderful talking to you and presenting to you all. I hope you all have a great weekend and thanks again for joining this session.